All, hello. Good afternoon. Dear participant, welcome to our webinar on EAC domestic tax regimes and the proposed measure for 2023-24 budget in EAC partner state. Actually, our objective of the webinar is to give you insight of the tax proposal from the EAC partner countries, which are Tanzania, Kenya, Uganda, and Rwanda. We could not bring the proposal from South Sudan and Burundi because the two, actually South Sudan have not started implementing the EAC commitment, but also Burundi has not aligned its budget year with other EAC partner state. And the DRC, the new member, also has not started implementing the EAC commitment. During the pre-budget consultation of the Minister of Finance, among the other things, actually, they agree that the budget reading for this year will be on 15 June. So we're expecting the budget reading for Rwanda, Uganda, Tanzania, and Kenya to take place in 15 June this year. So our webinar will be facilitated by a tax consultant from our partner, PwC. So we'll have a proposal from Tanzania, from Kenya, from Uganda, and Rwanda. Now, my name is Njau, and I'll be your moderators. So without wasting much time, let's look at the program of today. We are going to start our program with remarks from EABC Executive Director, Mr. John Bosco Kalisa. Then we'll have official open remarks from Mr. Simon Kaher, who is the EABC Vice Chair, Uganda chapter, but also EABC Chair of Policy and Advocacy Committee. Then we will have a brief presentation from EABC to give us insight on the comparison of domestic taxes across EAC, where we are going to focus why we needed to harmonize domestic taxes. Then we will have a presentation on the tax proposal from Tanzania for next fiscal year. And we are going to have a Johnson John and Fadhila Tisekwa from PwC Tanzania. Then after that, we are going to have also a tax proposal from Kenya, where we are going to have a presentation from Hannah Wanyonke and Nicholas Kahiro from PwC Kenya. Another presentation will be from Uganda, and it will come from Juliet Nalinda and Trevor Lukanga of PwC Uganda. The last presentation will be from Johanna Mbuya and Emmanuel Mlawa from PwC Rwanda. We are going to have a few rules, and the rule actually will assist us in making our webinar more efficient. So we are requesting to mute your microphone and the video if you are not speaking. And when you contribute, please make sure that you contribute to the meeting goals, where we are focusing on the tax proposal for 2023-2024 for the 4 EAC partner state. Stay on point and time, and you have to focus on the topic we are talking about. question can be sent to our chat room, and please note that the meeting will be recorded for reporting purpose, and the report of the meeting will be shared after this webinar. But also, if we want to ask any question, please raise your hand. Then our IT persons will identify you, and then you will start talking. Now I'm inviting the Mr. John Kalisa, our ED, to have welcome remarks, and even inviting our Vice Chair, Mr. Samuel Kaheru. Welcome, Mr. John Bosco Kalisa.
Thank you very much, Adrian Njau. First of all, allow me to commend and appreciate our chairman, responsible for Policy and Advocacy Subcommittee, Simon Kaheru, for sparing a minute on his busy schedule to join us and officiate this important webinar, where we'll be looking at the measures, taxes that are being introduced. My appreciation also to the board director present on this webinar, and also allow me to appreciate our partnership with PwC in terms of their knowledge, their insight on taxes, and the proposed measure that will inform our budget reading 2023-2024. It is also my my honor and great pleasure to welcome all private sector members, EABC, and the other stakeholders that are joining us during this important webinar, where we are going to highlight some of the measures that are going to be introduced during the budget reading. As Adrian mentioned, that the reading is expected in June by EAC partner states, with the exception of South Sudan, Burundi, and DRC, who are working tirelessly to ensure that they are also aligned their budget reading with the other 4 partner states. It is always important that when we look at the new measures being introduced, we remind ourselves and reflect back where we are coming from. And this is also to appreciate our leaders, the political leaders, the policymakers, that there is a lot of innovation and a lot of technology that are being embraced within our tax structure. And we see a number of initiatives, a number of innovative instruments that are being initiated, but all geared towards supporting or stimulating our economic growth. And I think that is very important to reflect on as we build back better from the devastating impact of COVID, climate change, and the recent Russia-Ukraine. We need to look into the measures that are able to enhance our food security. So whatever we are discussing, we need to ensure that we build a strong and sustainable resilience in terms of our food security, especially our agriculture sector, which almost employs 70% of our population. It is also important that we look at the self-sufficiency and self-reliance aspects, as our economies are now grappling with heavy external debts. We need to also ensure that the measures that are being designed or introduced are able to support and build our economic resilience as a region from external shocks, the COVID conflict, as well as the changes in the weather patterns. So as we talk about the taxes, it is always important also to always remind ourselves important canons of taxation, that any tax or any measure introduced, we must ensure that it is predictable. It must enhance certainty. And so we need also to ensure that it is less burdensome to the taxpayers. So we need to always ensure that we eliminate cascading effect, that is a tax on other taxes that are being introduced. So this webinar comes at the right time when we concluded as EABC training looking at the corporate structure, corporate taxes, and I'm happy that the rates are being harmonized. But there's a lot of arbitrary misinterpretation or interpretation. There are other inbuilt taxes, which also becomes difficult for doing business in EAC. I was also looking at the area I'm coming from a meeting with the World Bank, and now the level of informality is growing in East Africa. Generally, I learned today that Tanzania is second to Nigeria in terms of the growth of informal sector. So one of the reasons why informality is growing is that our tax structures are so heavier for SMEs. So it really inhibits the growth of our SMEs. So as we look into the measures, let's be candid, let's be open, and look and also advise our government in terms of those measures that are detrimental to the growth of our SMEs, to the growth of our business, including corporates. That also comes to the fact that when you look at the intra-regional trade, it has been stuck at around 20%. One of the measure or one of the binding constraints for the growth has been also the tax, lack of harmonization of both domestic tax, but even other taxes that are detrimental to doing business, including the recently introduced digital tax. So we must have a deliberate policy intervention to ensure that we remove or we address or reduce those taxes that inhibits the business growth. So our view at the EABC, we want to ensure that there is a very close collaboration between the government and private sector before any measure is introduced. There is that kind of constructive dialogue, constructive engagement, discussion, debates around these measures, so that we're able to grow businesses, we're able to move some of the segment of business from informal sector to formal sector. So I believe that during this discussion, we are able to eliminate some ambiguity, we're able to remove those nuances in terms of business growth, but also in terms of attracting investment, both cross-border investment as well as the foreign direct investment. That is the way to go. That is the way to go to be able to weather the current external shocks. We need to build a strong, sustainable, and robust private sector. We can only do that when we have a robust tax regime and very competitive tax regime. So with that, allow me to invite my chair of the subcommittee, Simon Kahel, to deliver his opening statement. Karibu sana, my chairperson of the subcommittee.
Asante sana Bwana ED, nashukuru kabisa. I trust that you can hear me clearly.
Yes, Chair, we can.
Okay, thank you.
We can hear you
much.
very well.
Yeah, and thank you, Adrian, for kicking us off very well this afternoon. First, I recognize our board members present here of the East African Business Council. Thank you very much for making time, and also CEO. I must thank you for always being available. Many people wonder how many people you are because of the number of events that you show up at. So we must thank you. We thank our partners at this event, PricewaterhouseCoopers, PwC, and Coca-Cola, that has been supporting the tax harmonization project. Our panelists today, very many of you, but all of you experts in your fields who are going to give us great insights, and everybody who has joined this afternoon as a participant and attendant. Of course, the media fraternity should not be left out. I'm part of you, and I'm happy to see you here from across East Africa and probably beyond. Ladies and gentlemen, it is important for you to take time out of your busy schedules for webinars, discussions such as these, because of how much they mean to all of us in the private and the public sector. And today's event, we should note, is one of the most important in the budget or fiscal calendar in East Africa, because it has become an annual webinar that is, as you can see from today's attendance, treated very seriously by both sides of the economic divide. That's why we need to continually appreciate PwC for stepping up to the plate this year to ensure that it happens, and for providing the experts to allow us to have this discourse. So we applaud you for your support today. Both Adrian and CEO have stated that Burundi is still aligning its fiscal year, and South Sudan has not yet started implementing their EAC commitments, but we are positive that our brothers and sisters there will be with us in this process, because we're already doing business with them. So we trust that in a very short while, we will see a complete process. But this process we speak about is the harmonization of our budget reading, our fiscal cycle, which is only part of the equation. However, it is still a very important part of the equation, because it provides a level of stability out of predictability, because we as the private sector get the opportunity to engage with the government at the same time across East Africa, the governments, plural, across East Africa, and therefore to make informed business decisions. And we make these decisions counting on these governments to meet their commitments made during the annual fiscal planning. Ladies and gentlemen, as Edie has said, we are now entering a new fiscal year where, again, we are continuing across the world, all economies across the world, continuing with many issues that we've been grappling with: economic issues, social issues. These are, it's a long list of issues, challenges, problems, as some people call them, and reasons. In the private sector, as you all know, we do not entertain excuses. So they are not excuses. These are genuine shocks and headwinds that have been felt right across the globe in developed economies as well as developing economies. And our news cycles repeat every day how realistic they are wherever you are. The COVID-19 pandemic made it clear that a global shock could be felt globally and hit high and low. But we've seen many others that initially we did not believe would hit the highest as much as they would hit the lowest. Whether it's higher international prices, climate change, the war in Europe, which has had many repercussions, a war right here in Sudan that's also having repercussions of its own, even though for some reason in East Africa we don't discuss it deeply enough, and many other reasons. These reasons are genuine, and we as the private sector do not sit back and lament, never. However, one thing that we should all agree here, and I hope we have some members from the government attending, joining us this afternoon, is that whereas the private sector has spoken about these reasons for economic stress and a downturn in business activity, the governments have spoken even louder than we ourselves in the private sector. And when we acknowledge that, we should have that expectation, or even higher expectations, as the private sector in the East African community, that the governments that have felt these shocks just as much as we have should be putting in place new tax measures that will take into account the efforts that we are making to fix these issues, to fix these problems, to build forward in order to reverse the negative impacts of these challenges, both here in our region and globally. As we have been discussing with various government partners, these tax measures should not worsen our business environment. Instead, we need the governments to work closer with us so that we are together creating the right business environment so that the private sector can thrive and expand across the EAC borders and beyond. And the understanding should be clear that if the private sector thrives, then the public sector will survive. Again, if the private sector thrives, then the public sector will survive. And that is why in the EAC, we focus on ensuring that regional integration is private sector-led and people-based. Because trying to integrate in any other way, as we have seen all around the rest of the world, it cannot work. That's why, ladies and gentlemen, today the webinar is going to focus on the various proposals that have been put forward by the governments that have been mentioned as having done so far. And these will range from excise duty, income tax, value-added tax, as well as tax management measures, whether it's a digital tax stamp. Those of you who know me very well, you know that there's no meeting that will pass where I do not speak about digital tax stamps, our common external tariffs across East Africa, and the adherence to the harmonization of these taxes across the region. Because as the ED has said, the trend is worrying around where these economies are going, how much informality we are seeing rising in this region and on this continent. The freedom to develop and manage domestic taxes at national level has existed from time immemorial, and that's how nations were built. But we are now speaking more to regions because of the widening markets. And in order to do so, we need the governments to address unfair tax competition, unequal treatment of taxpayers, goods, services, in a manner that allows that movement of the goods and services that we believe can grow the East African economy without impinging on the national economies. And these are the conversations that we're looking forward to hearing today, the insights that our experts are going to give us, which insights will advise our partners in development on the public sector side. Because when you think about informal business activities, who loses the most? It would be the tax collectors, the governments, the public sector. But that does not mean it's the government officials who lose. It means it's the people of East Africa that lose. And therefore, ladies and gentlemen, as we go into the discussion this afternoon, I urge you to please pay keen attention to our experts. Let's pick up on the insights that they're going to share with us, but also contribute. Contribute heavily this afternoon and in the conversations to come, because the timing of today's webinar is very, very specific to enable us the next 2 weeks to continue engaging with our government partners, and then thereafter to go with them into implementation. Because we as the private sector play a part as after the budgets have been read. But all that said, let's also acknowledge that national budgets are not only about taxes, just the same way business is not just about revenue, but all the other attendant factors that contribute to that revenue. We must look at the national aspirations in all our East African partner states with regard to infrastructure development, which includes technology and innovation, people development on the social front, and that includes social development, health, education, environmental concerns, and very importantly, strategies to grow our market into the rest of Africa and the world. All these being on the table with the right execution, the mind frame of the private sector, I believe that as a community, East Africa will thrive, and therefore our public sector, our people, will survive. With these few remarks, I declare our webinar officially open and look forward to hearing more from the experts and seeing action resulting in proper economic benefit for East Africa. Nashukuru sana.
Okay, thank you very much.
Asante sana. Very good. Thank you very much, Simon. And that was a very strong opening statement. So over to you, Adrian, now.
Okay, thank you very much, ED and the chair for the opening remarks. And with the interest of time, suppose actually to make a presentation on where we are going to look the comparison of the domestic taxes in EAC, and also briefly look the harmonization process of domestic tax in EAC.
Adrian, may I suggest maybe for the interest of time, because people have picked interest from the PwC, if your presentation could come after the PwC team, then you look at maybe those, because we already got it. So I suggest so that we don't lose the audience, they give us the current burning issues on the various budgets.
Yeah, for what we have agreed, they will go country-wise.
Yes, yes.
But mine will look at the totality of the disparity of domestic taxes. Very brief.
Okay.
Oh.
Adrian, you are muted. We can't hear you.
Yeah, we are waiting our IT to project the presentation on the disparity of domestic tax in EAC.
Okay. It's taking a lot of time, Adrian. Can we get the next presenter to present in the interest of time?
Okay, maybe we start with PwC, if they can start projecting the presentation from Tanzania. Manage, you can see the presentation.
Good afternoon, everyone. This is Johnson from PwC. I mean, by way of introduction, I think that's. Hi, Adrian. Can you hear me? Just to confirm.
No,
we can hear you,
I think
Johnson.
we can start projection. Okay. From EABC presentation, actually, we are looking the comparison of domestic taxes, where we are looking the income tax, value-added tax, excise duty, and then we'll look the brief justification for harmonization of domestic taxes, the then challenges of unharmonized taxes. Regarding the comparison, as you can see, on the income taxes, we have grouped them in the taxes on employer and the taxes burden on employee, as well as the withholding taxes. And in terms of the taxes of employer, you can see as for the current budget, the corporate income tax for Tanzania was 30%. Kenya, Uganda, and Rwanda was also 30%. So in terms of rates, we don't have much challenge. Maybe the challenge will be in some of the strategic area where each partner state have decided to give some relief or incentives where they lower the corporate income taxes. On the social security, which is the contribution of the employer to employee for national social security, we have 10% for Tanzania, Kenya is 6%, Uganda is 10%, and Rwanda is 5%. But the good thing about Kenya, you find that for employer, you will contribute 6%, but when there is a maximum, if your salary is 18,000 Kenya shillings or beyond, they have put a maximum contribution. There is another tax for the employer, which is the skill and development levy, where in Tanzania, I think it was 4%, and this tax actually is not available in Kenya, Uganda, and Rwanda. Another type of the tax which employer is supposed to pay is the worker compensation fund, which is 0.5%. And in other 3 countries, actually, this tax is not being charged. But when you look at, there is another one, which is maternity leave benefit, which actually is available in Rwanda, which is 0.3% of the wage bill or salary. In terms of the taxes on employee, we have an income tax, and here we have looked the maximum rate, which is 30% across the countries, and the social security is 10% for Tanzania, and Kenya is 6%, 5% for Uganda and Rwanda. In terms of the withholding taxes, you find that actually across the country, we have 2 types of withholding tax, which is charged on resident and non-resident. For example, dividends is 5% for resident in Tanzania and 10% for non-resident. The same apply to Kenya, but for Uganda, you find it's 10% for resident and 15% for non-resident. You can see also Rwanda, and that's where we have some differences. And when we are talking of non-resident, actually, you find also it includes the EAC, legal or natural person. And to some people, I think it creates some sort of the discriminatory. Another slide is about the value-added tax and excise duty. And here you find, for example, the VAT rate, the standard VAT rate across the EAC is almost the same, where in Tanzania is 18%, but in Kenya is 16%. But another rate for Uganda, for Kenya, you find that it's 8%, which is a reduced rate for the petroleum and motor spirits. But in another rate is zero rated, where you find that some of the product are zero rated, apart from being export. And here, that's where we have some unharmonized in terms of the product which are zero rated. For export, in Uganda, Rwanda, and Tanzania is zero rated, which the rate is 0. And for goods in Kenya is zero rated, but we had some challenge in terms of exempting for services in Kenya. But I think maybe these anomalies will be rectified in this financial year. Excise duty for petroleum across the country, actually, we are using the same method. Maybe the rate may be different, but we are using the specific for all country. For non-petroleum product, I think that's where we have some differences in terms of the method, where we use specific or ad valorem for Kenya, Uganda, and Tanzania. But in Rwanda is mainly on ad valorem. But the biggest differences here is related to the amount which we charge on different product, even the list of the product which we consider as accessible. And in the excise services, we have some challenge in terms of where the rate are differences. And you can see Tanzania is charging higher rates when it's come to electronic communication services, which is 17%. And for money, transfer is 10%. So that you can see the disparity in taxes. In terms of the justification of harmonization of taxes, we are saying that the all stage of EAC integration, we are talking of the customs union, common market protocol, and even monetary union, actually emphasize the need for harmonization of domestic taxes or taxes policy with the view of removing tax distortion in order to bring about a more efficient allocation of resources within the community. And in terms of the challenges on the harmonization of domestic taxes, we have seen that because of the disparity or unharmonized taxes, actually we have seen frustration of the EAC intra-EAC trade and investment in terms of the movement of goods, movement of services, movement of capital, as well as movement of service supplier because of the different taxes across the EAC. But also another challenge is that at EAC, you find that there is a EAC agreement for the avoidance of double taxation and the prevention of fiscal evasion with respect to taxes on income, which was signed by all the partner states, 5 partner states, in November 2010. But unfortunately, the agreement has not come to force because Burundi and Tanzania actually have not ratified the agreement. But the other 3 countries, Kenya, Uganda, and Rwanda, have ratified the agreement, but the agreement cannot come to force because the 2 parties of the agreement have not ratified. Once this ratified, actually will address a lot of challenge with respect to income taxes. And at EAC, we are saying we have a policy on how to harmonize domestic taxes, which is a roadmap, but is a policy which actually give us a leeway on how to harmonize domestic taxes. But this is not taking place, and we have seen the slow in terms of the harmonization of domestic taxes. And what we are saying in terms of the conclusion at EABC, since we have the policy already on how to harmonize domestic taxes, it is high time for the partner state actually to fast track the harmonization of excise duty, of value-added tax, and income taxes. But also, we would like to see the EAC partner state to allocate more resources to EAC Secretariat, especially the department which is supposed to deal with the harmonization of domestic taxes, which is fiscal and monetary department. Also, another area is actually, since harmonization is not going to harmonize illegalities, we are saying in the area where we have been experiencing discriminatory domestic taxes, it is high time those taxes are eliminated. And when we are talking of harmonization, we harmonize something which is legal. But also, private sector need to be proactive by coming up with a harmonized position in area of harmonization of domestic taxes, because in some areas where you find that some private sector actually are benefiting, it becomes very difficult for them to harmonize, especially area of local content. That is end of my presentation. So I think people need to reserve their questions, and then after we get all the presentation, then we'll come to the question and answer. So without wasting time, I think I invite the PwC to come and starting giving us their tax proposal from each country. Welcome, Johnson or Fadila.
Thanks very much, Adrian. Maybe if I can confirm that I'm audible.
You are very audible, and we can see your projection already.
Okay, great. Thanks very much. So from the PwC side, I think as you had mentioned earlier, we have representative from 4 countries, the member state of the East African community, that being Tanzania, Uganda, Kenya, and Rwanda. And myself and Fadea will start on the Tanzania side. But before doing that, we had prepared something for as a comparison, which I think most of that bit have already been covered. So what we will do for the purpose of this presentation is just maybe to talk a bit on the differences or the budget process that we have across these 4 countries and the differences that are there. So what you're seeing in our screen, and maybe Adrian, again, you can confirm that our slides have moved to the budget process slide.
Johnson, can you proceed? We can see it, but can you start your presentation from the first page? It's important. We want our members to go through step by step.
Okay, thanks very much. So yeah, maybe I'll just run through from the very beginning. Most of these have been covered by Adrian, so I'll make it very brief. Now, okay, so from a PwC side, our presentation is divided in 2 parts. One, to look at the general legislative regime that we have in place currently, and comparing it across the 4 countries that we have. But at the same time, the second part will be deep diving into the budgetary changes that we expect. So in Kenya and Uganda, they already have a bill, so they already have an anticipation in terms of the changes. In Tanzania, the bill is not yet out. So what we'll be talking through are different submissions and proposals that have been done by the business groups and various stakeholders. So without further ado, maybe just to start on the outlook of the domestic taxes and looking at the employment taxes. Adriana presented this slide. I think just to put it in perspective, what you see there is on the Tanzanian side, while comparing it to the others, you'll see that the employment taxes on the Tanzanian side is a bit on Tanzania is a bit on the higher side, particularly the taxes that are being levied by on the employer. And in addition to that, there is a bit of duplicity in terms of these taxes and contribution that have to be made. We start increasing the number of compliance obligations. So effectively, in Tanzania, the employer has to pay taxes at a rate of 14.5%. Similarly, also on the social security contribution, the effective rate, which is 10% on the employer side, 10% on the employee, with a total of 20, is higher than what we are seeing across the region compared to Kenya, which is nominal, Uganda 15%, and Rwanda 5%. On the withholding tax side, maybe there is not much there to touch on because the rates are basically varies. But the key thing to note is the rates are mainly driven by the residence of the recipient, the company or the individual you're paying. So roughly, if you're paying, if you're making a payment to a resident company, the rate will be varying around nil or probably the exempted payments to a rate of 10%. Whereas if you're paying to non-resident company, the rate varies mostly around 10 to 20%, but there are incidences, special cases where you could have a slightly higher rate of 25% or 30%, as you can see in Kenya. On the VAT side, again, it's more or less as has been presented earlier, but just one thing to emphasize on in terms of the difference is on the export of services, where across the region is that the exports are generally zero rated. I mean, to align with the key principle of VAT being a jurisdictional tax. But there was a recent change in Kenya where that the VAT at a rate of 16% was also extended to services being exported out of Kenya. Our colleagues, when they come to talk on the proposals, they will touch a bit on that. There have been discussion on repealing this provision because I think otherwise it generally goes against the basic principle of VAT and also discourages cross-border transactions as it increases the cost. Now, maybe moving on to the budgetary process. As touched on a bit, in Rwanda, they don't really follow this budgetary process. The changes tend to come on a periodic basis as and when required. And recently, they had tax reforms issued early this year in January. So that will be taken aside. But mostly when we're looking at the budgetary process, we're comparing Tanzania, Uganda, and Kenya, and both follows more or less similar steps in terms of there being a submission from stakeholders, discussions, and then issuance of the finance bill. The key differences that we are seeing there is, and you will see it on the law before last, is in terms of the timeline for issuance of the finance bill. In Uganda and Kenya, generally the finance bill comes a bit earlier, as I'd already alluded to earlier, that Uganda and Kenya already have their finance bill. But in Tanzania, this tends to come in mid-June. And with it, there is a disadvantage that there is not enough time for companies and other stakeholders to engage, give out comments, and try to sort of influence the changes that are being proposed. The other key distinction, and this is on the, we're seeing in Uganda, in addition to the bill coming a bit early, also the Finance Act, at least the draft, the Finance Act tends to come also a bit earlier. With that, it gives a room to the companies to structure their processes and, if need be, change their systems to be able to comply to the changes. But compared to Tanzania and in some instances Kenya, the challenge you are seeing is most of the time the Finance Act will come around the dates of it being effective. Therefore, not giving a lot of time for the business to adjust to be able to comply with the requirements introduced by the Finance Acts. Other than that, generally, across these three jurisdictions, all the Finance Act, the changes become effective on the 1st of July. Now, in interest of time, I think we can proceed with the second part, which is we'll be looking at the proposed changes for the year 2023 and 2024. For Tanzania specifically, as I'd mentioned, what we'll be covering on will be on the changes that have been submitted as part of the proposals by different business groups. So some of the changes that the businesses are anticipating to see in the upcoming finance bill. The first one and the key outcry has been on the budget process, which I think we have already talked on. Trying to give a bit more time between the issuance of the finance bill and it being discussed, the issues of the Finance Act and it coming into force. The other request that have been put on is the removal of the requirement to maintain a primary data server. So you'll be familiar with this. It's a change or an introduction that came in 2021 and was supposed to be effective in July 2022, but then got postponed and is now anticipated to be effective in July this year. The concern here is it goes against the development, the technological development that we are seeing across the globe, where businesses are moving into cloud. Businesses, most of the companies being on the group setups, but as well as just the easy of going through it and the cost efficiency. The challenge here is it's going to be costful to the business to comply with this requirement, especially considering that in any case, most of the businesses are already doing their storage in the cloud. But again, it's going backward. I mean, we'll be going backward technologically wise. This third proposal that we have is a removal, probably putting a pause on accrual of late payment interest particularly during the dispute resolution. So the request here is if at all the interest, the payment interest continue to accrue, then it should come to a stop once the matter has gone through the dispute, for two specific major reasons. One being the taxpayer doesn't really have control in terms of the timings, how long the dispute resolution can take. So charging interest during that time is a bit unfair on the taxpayer side. But on the other end as well, to be able to go through the dispute resolution, the taxpayer is already required to have paid at least 1/3 of the taxes that has been assessed, and that should cater for the time value, any leakage in terms of the time value of the taxes that the Revenue Authority should collect. But in addition to that, the businesses are also proposing for a cap on the late payment interest, because we have seen instances where it has accrued and become significant, even exceeding the principal taxes that are being levied. So there is a proposal for a cap of it to at most 100% of the principal tax liability. In other words, you would have seen this same cap being applied on the traffic offences, where once it reached an amount similar to the principal penalty, then the late payment stops to accrue. Now, moving on, an additional proposal has been on the registration of storage facility, and this has been an area of significant outcry, especially with the recent debate that have been ongoing in the carrier core. And the key issue that we are seeing, or the businesses are seeing here, is in terms of clarity on applicability of these provisions. So there are key terms being used in the registration which have not been defined, and therefore it's not clear how to go about it. One of it, there is a sort of an implication that it applies to both the owner of the storage facilities as well as the operator of the storage facility. So there's no clear demarcation there on who exactly should the provisions apply to. But the other issue is the provision talks about a person who keeps goods for the purpose of business. Now, there is no clarity there if the provision only looks at the goods that are being stored for the purpose of sale, or it will also look at the inventory that are stored for by the businesses, which is a bit of a longer term storage. And in this circumstance, you might see that businesses might be storing inventories even for the purpose of internal consumption. So it's not clear there whether such scenario would also be captured under these laws, and in such instances, then the business also need to do a registration and a monthly reporting of the stock that they have. The last three proposals that are there on the tax administration side are mostly to do with the dispute resolution process. The first one is on the waiver request. So as we all know, the law requires for a company to pay at least, to pay 1/3 of the tax that has been assessed, of 1/3 of the tax that has been assessed, or the tax that has been considered. Most of the time, the 1/3 of the tax assessed tends to be on the higher side, or a bit significant. There is a bit of flexibility in the law in terms that the law allows for a request for a waiver of that deposit, but we have seen instances where those requests for waiver are being rejected, and the law does not provide clarity on what should be the process, what should be followed in case that request has been denied, because otherwise, if you don't do the deposit, then the objection will not be admitted. There have been various cases that have gone through the appearance bodies, and a bit of mixed results also coming from the appearance bodies as well. The second thing on the objection or dispute process is in terms of clarity on time for objection admission. So there is also sort of a newly, in terms of the number of years, introduced a requirement or provision that the commissioner is now supposed to determine an objection within 6 months from the date of admission. Otherwise, the assessment is considered to be final. Now, that 6 months window is pegged to the date of admission, but the law does not define what the date of admission is. In practice, we have been seeing TRA considering that date to be the issuance of the admission letter, but there is no clarity in terms of what applies in scenario where that admission letter is not issued. The other thing, and again on the 6 months window, as I'd mentioned earlier, where the 6 months period has elapsed, then the assessment is deemed to have been determined or considered to be final, but is that deemed determination is on the favor of the TRA. So you're going back to the position that the TRA had assessed. This one is a bit punitive again to the taxpayers, but also sort of disincentivize the TRA from going with this 6 months window, because there is no incentive for them to fast track the dispute resolution process and finalize it. So the request is one, to try and probably extend that window a bit, maybe to a period of say 9 months. And this is in line with what we are seeing in if at all there has to be a fallback position, then that fallback position should be in favor of the taxpayer. In other words, the assessment should be ruled in line with the objection. Now, moving on the income tax side, there are a number of proposals being put by the businesses, but key ones are one on the write-off of bad debt, which the law generally provide for bad debt to be written off, or deduction for write-off bad debt to be claimed only if the company has taken all reasonable steps in following up on that debt. The challenge here is there is no definition of what would amount to a reasonable step. And what we are seeing in practice is that TRA expects the companies to have exhausted all the steps in following up on the debts. On the proposal with regard to foreign exchange differences, the law requires deduction for foreign exchange differences to be claimed on realization basis. In other words, you can only claim once the foreign exchange difference has been realized. The tricky part here is for foreign exchange differences realizing on capitals, it's very difficult.
I think, Johnson, you are breaking up. I don't know what is the challenges.
Can I confirm, Adrian, if you can hear me still?
Now I can hear you, but sometimes you are breaking up.
Okay. It might be an internet on my side, but I hope it's better now. So foreign exchange difference, the challenge is mostly on the short-term balances, where it's very difficult to track realization for this, because it tends to be a daily, sort of a daily movement, and the number of items involved tend to also be significant. And in any case, during audits, the Revenue Authority would want documentary evidence to support this realization, which is very difficult for short-term balances. So the request from the business on this end is for the deduction on foreign exchange differences for short-term balances to be granted based on the accounting basis. So once you have accrued for foreign exchange difference on a short-term balance, the same should be deductible, and the realization basis of deduction should only be reserved for long-term loans where it's easy to track the realization. Then on the employment tax side, there are a couple of suggestions. I would probably bundle them together, and it alludes to what I mentioned earlier, which is there is a duplicity in terms of levies and taxes that are to be corrected, particularly on the employer side. And the rate, the effective rate is on the higher side as well, even comparing to our neighbors across the region. So the proposal here is to reduce the rate first on the SDL, to reduce this to 3%, and harmonize or sort of combine the SDL and WCF, probably allocating 2% to VETA and 1% to the WCF fund, and effectively abolish a separate compliance requirement on the WCF. I think that's that in terms of the first part for Tanzania. I would welcome my colleague Fadhira to present on the changes being suggested on the indirect tax side. Thanks, everyone.
Thank you, Johnson. Adrian, can you confirm that you can hear me?
Yes, we can hear you, Fadhila. Welcome.
Asante. So I'll be taking you through the indirect tax proposals that have been brought forward for VAT excise and digital services, as well as mobile levy and airtime levy. These are not all the proposals, but some that cut across the sectors and some that affect the economy at large. So just to start with VAT, there has been a proposal to reduce the VAT threshold from the current 100 million, which is approximately 40,000 USD, to double that, which is 200 million. And this is part of the an effort towards rationalization of taxes on SMEs. The issue being that SMEs face a number of challenges which affect their growth and profitability, and one being the multiplicity of taxes and tax legislations that they have to comply with. And also the lack of experience or knowledge on tax matters. Consequently, they find themselves attributing most of their revenue to paying taxes, and ultimately it threatens their existence. Or speech had mentioned an interesting statistic that Tanzania is second to Nigeria in terms of the informal sector. So this proposal, I guess, in terms of its rationale, is that first of all, simplify compliance obligations for SMEs by relieving them of the burden of complying with some taxes. At the same time, encourage them to join the formal sector, because if you reduce their burdens on compliance or with taxes, then they wouldn't feel the need to, hide in the formal sector. So this would encourage formalization, which in turn also boosts the government revenue. This proposal, would it have an impact on revenue? We don't think so, because first of all, the input tax that would have been claimed by these SMEs, which would now be outside the net, will no longer be recoverable. And then at the same time, statistically, it's proven that most large businesses account for like 84% or more of the VAT revenue. So removing this few SMEs from the VAT net wouldn't have a significant impact. Said that, if the SMEs or the businesses, the private sector thrives, then Tanzania, the country and region would also, thrive. And I think this would be a timely change, especially given that we have the AFCFTA also kind of presenting new opportunities. So it's an important time to also boost and encourage, SMEs to grow. So that is the first proposal. Then the second one is on post-supply rebates and discounts. This touches businesses which have the rebates or discount models, which are post-supply. So what we have in our VAT legislation talks about accounting for discounts or rebates at the time of supply. Now, in cases where there's a contingent discount or rebate, which you can't really tell, you can't know at the time of supply, then it becomes hard to comply with this law. So again, we are suggesting that they reword this VAT reporting requirement when it comes to rebates and discounts. But also at the same time, there's an issue where it's accepted to be treated as a post-supply adjustment. There's usually something called an adjustment note, which is introduced by the Tanzania VAT Act. So they don't recognize credit notes per se, but they recognize a form called an adjustment note, which is supposed to be issued in a prescribed form and manner. Now, the issue is that in that adjustment note, you would have to include, make reference to the invoice to which the adjustment is being made. But when it comes to discounts and rebates, they're usually based on KPIs, which can't be directly linked to a specific invoice. So again, it makes compliance difficult. And therefore, we're proposing that if they either remove the issuance of adjustment notes in these scenarios, or come up with special adjustment notes, which can be more practical for the businesses which are operating in these models. Last but not least, from the VAT, is exempt concession fees and park entry fees. As we know, the tourism sector is a very key and important sector in Tanzania. We believe that exempting this concession and park entry fees will make the sector less expensive and therefore attract more tourists. The exemption used to apply before, then the law changed in 2016, but now we are requesting that it goes back to exemption. When it comes to excess duty, there's a proposal to overhaul the Excess Duty Act, which is very old. The current Excess Duty Act includes merging very old legislations, which date as far back as in the 1970s. So it was originally enacted for goods, but now we have services also falling within the scope. But then again, when you look at the act in totality, it's like it's not really adequate for the supply of services. The call is basically to modernize in working towards this, because there's been some stakeholder engagement. But as we wait for this to come to fruition, we are also proposing other quick wins in the time being, including reduction of excess duty rates on telcos from 17% to 10%. There's a lot of history here in this point, but then essentially is that to make this the telco services, which is communication service, more affordable, but also to mention that this sector is really heavily taxed. When you look at the tax on turnover, it's about 40.4%, and also it is taxed disproportionately to its contribution to GDP. So again, formalize some other businesses and sectors, but also reduce the reliance on some specific sectors, which can hurt, investments, as well as even the government revenue, because if you tax it less, then there's also more taxable profit, and hence, again, more corporate tax that can be obtained in this area. And then another proposal in disputes in this area, and we just believe that it's not aligned to the principle that excess duty is a single stage tax and not a multi-stage tax like VAT, for instance. So we've seen a lot of disputes, and maybe clarifying the law to say that supplies to intermediaries should not be taxed would help, because there's a similar provision when it comes to goods. Another proposal is to include provision a provision to exclude excess duty on export of services. Again, this is an inland tax, and also it should be taxed based on where the services are consumed. I know, for instance, Kenya, they have an explicit provision which exempts, excess duty on export of services. So that is that on excess duty. When it comes to digital services from non-residents, from a VAT perspective, we had a law since 2015, but it was hard to administer or to apply. So recently, they've issued regulations which provide a simplified ways that non-residents who provide digital services to unregistered people in Tanzania to register and pay tax, pay VAT. So the issue with these regulations that have come through is that they provide no threshold, and so the proposal is to actually clarify the regulations by removing this clause, which causes ambiguity, kind of implying that there's no VAT registration threshold. Again, the VAT registration thresholds are actually usually included in laws as part of the best practices. Mr. John Bosco, I guess, said that we need taxes that follow the canons of taxation, and one of them being that you need to have an efficient tax system. So without a threshold, the system becomes inefficient because it only increases compliance costs to businesses as well as administration costs to governments. So again, we are calling for a threshold for the regulations to be reworded so that the threshold which applies generally should also apply to digital services, as well as a proposal to remove a provision which talks about non-residents are not allowed to claim input tax claims. This is against the principle of VAT neutrality, meaning that the businesses are supposed to be bearing the VAT cost. So allow them to claim input tax. And then the last one is extend the timeline for filing of returns and related payments. Currently, they've been provided only 7 days to file and pay returns, make payment of VAT, while other businesses have a 20th day timeline. So again, this is too short and it's not practical for the non-resident suppliers, and therefore the which is the 20th day of the following month. The last proposal that we are going to touch on is on the mobile money levy and airtime levy. This was introduced. There wasn't much stakeholder involvement when it was introduced, and therefore a lot of outcry in this area. And we've seen changes in the money levy gradually decreasing over time. But the call is to actually remove these levies altogether, because it would first of all, the introduction of this levy has been detrimental to mobile money transactions in terms of volume and value, so also impacting the government revenue. But also, if you remove these levies, then it would accelerate the government's ambitions and long-term plans, which include driving financial inclusion and also building, a digital economy. So I think I'll pause there and hand it over to the next speaker, who is from Kenya. I think Hannah. Thank you.
Thanks, Fadila. From a Kenyan perspective, yes, the government or the National Treasury released its finance bill, and the proposals that we are articulating here are contained in the finance bill. Being the first finance bill for this government, it has been quite extensive. We're estimating the proposals were roughly around 84, which is quite significant. Most of them were accounted around one, in terms of increasing the tax base, so they're trying to rope in new taxpayers. And the second, trying to deepen the tax base, in this case, increasing the rates of various tax. And finally, it's around real-time collection of taxes. I think the government has been facing some times in terms of liquidity. So they are trying to ensure taxes collected are paid quite early enough. So they are trying to come up with mechanisms to ensure they collect all the taxes as soon as possible. I'll touch base on an income tax perspective. And the first one that comes to mind is around withholding tax that has been introduced to payments that are made to digital content creators. Now, such payments will attract withholding tax at a rate of 15%. This is anchored or trying to bring in or rope in new taxpayers on board. The second one is around introduction of digital asset tax, which will be applicable at 3% in relation to transactions that are covering cryptocurrency and non-fungible tokens. So anchoring on that theme of bringing in new taxpayers on board. The third one is around a proposal to introduce repatriated income, which will be applicable on branches. However, if you read the finance bill, no rate has been provided. I think in relation to this clause, we are last on party. I think this one has already been implemented by our neighbors, in this case, Uganda and Tanzania. However, we'll wait to see whether they'll give us the rate by the time the Finance Act is assented into law. Another bit the government is trying to come up with is no refunds of excess withholding tax paid arising from a TP audit adjustment. In this case, they are saying if an event, for example, you had accounted for withholding tax on payments that you have made to your non-residents, and the tax authority comes and makes an adjustment, you cannot offset that excess withholding tax vis-a-vis other taxes. In most cases, maybe the additional corporate tax the tax authority may want to impose on you. Another, you can say, at least a relief that we are seeing in the finance bill, they are trying to reduce the tax rate on residential rental income, which was initially 10%. Now they want to reduce it to 7.5%. And this is trying to bring compliance most you can say most landlords. Initially, the government has really been focusing on trying to tax this residential income from landlords. However, it has proved to be a bit of a challenge. So in terms of trying to ease or bring most people into compliance, they are trying to reduce the rate and attract more taxpayers. From an informal sector perspective, we have seen the government trying to mobilize more revenue. And in this case, they have increased the turnover tax from 1% to 3%. From where we are sitting from, it's a bit counterproductive because on one leg, the government is trying to bring in or rope in new taxpayers. However, on the other side or the other end of the leg, they're trying to increase the turnover tax, which mostly tends to cover informal sector. And you'll find most guys will tend to shy away from being compliant because of the increase in the rate. In terms of trying to embrace the new electronic tax invoice management system that's been rolled out currently, the government is trying to impose or make it mandatory for business expenses to be accounted using this system. If the expenses are not accounted using this system, or the invoices are not coming from the ETIM system, they are not being allowed or being given a tax deduction from a corporate income tax perspective, which from where we are sitting from, it's a bit premature because the system it's still on its pilot phase. And what we expect for the government is, first of all, roll the system, let people experience the platform. And once they are comfortable with it, now you can bring in other compliance measures or try to force taxpayers using the ETIM system. And then also in terms of trying to mobilize more revenue, we see the government has introduced or trying to introduce capital gains tax on indirect share transfers. This one previously, from a Kenyan perspective, only direct share transfers were subject to CGT. However, the government has maybe from where they're looking from missed an opportunity of collecting more capital gains tax. So they're trying to bring in more taxpayers into the CGT bracket. Moving on to the next slide, which covers employment taxes. The first proposal the government is trying to come up with is increasing the marginal rate of the PAYE from the current 30% to 35% to employees' earnings, which is more than 6 million. We are looking, that's roughly $43,000. And there has been a lot of hue and cry here in Kenya in terms of the increased rate. This is coupled with another introduction of another statutory deduction called the National Housing Development Fund, which will be also payable by both employer and employee at the rate of 3%, but capped to 5,000. So if you take both both proposals that are being fronted in the finance bill, it's limiting or reducing the disposable income available to most employees, hence the hue and cry that we are hearing from a Kenyan perspective. Moving on, from a tax administration perspective, we are seeing the government trying to extend the timeline for settlement of dispute out of court from 90 days to 120 days. This one is just to encourage taxpayers who have disputes that are sitting in the TAT on the Tax Appeals Tribunal to seek alternative dispute resolution mechanism as a way of easing or reducing the disputes that are being adjudicated. Secondly, moving on or coming in the lines of real-time collection of taxes, we have seen now the government is requiring taxpayers to withhold any withholding tax that has been deducted should be accounted for and paid within 24 hours, which is quite impractical on the basis of you'll find most taxpayers tend to have a mechanism or a governance structure in terms of various approvals being required before a payment is made. So in this time, forcing people to come up or settle the taxes within 24 hours, it's quite punitive. Secondly, we have seen the requirement to account for and remit withholding VAT within 3 days after the deduction, another mechanism or another stride by the government to collect taxes as soon as possible. I think on the final bit that touches also tax administration, the bill proposes to introduce a requirement whereby taxpayers will be required to deposit 20% of the taxes in dispute with the Commission of Taxes, or security equivalent to the 20% of the disputed taxes, where you file an appeal to the High Court against a decision of the TAT. I think this one is in line with what's being practiced in Tanzania. But from a Kenyan perspective, we are arguing we are making it costly for people to access justice, which goes against our constitution. And secondly, it's one way of collecting taxes that are already in dispute, which is the essence. The taxpayer has gone to the High Court to request the High Court to make a judgment against these decisions. So another punitive proposal that's coming through the finance bill. But at least we have had the first round of discussions with the National Parliament, and given we have aired our grievances, and hopefully they'll listen to our pleas as the taxpayers as well as the tax agents. I'll pause there and hand over to my colleague Hannah to take us through the VAT section. Over to you, Hannah.
Thank you, Nicholas. So I'll take us through the VAT proposals. Once I've done with the VAT proposals, I'll then proceed to and highlight the excise duty proposals. So the first proposal there on the screen is a proposal to repeal the 8% VAT rate currently applicable on petroleum products. And with this, the repealing of the 8% VAT rate, we see a change to tax petroleum or fuel products at the standard rate of 16%. This is not so good for the country because the country is highly reliant on the fuel and will lead to an increase in the cost of doing business in Kenya. Then the other proposal, we'll also see a move on the LPG, which is also classified as a petroleum product, will be exempt from VAT. And this is with an attempt to make the LPG gas affordable to the citizens. So that will bring to an end the 8% VAT rate in Kenya. So the other proposal is to exempt exported taxable services. With effect from 1st July 2022, exported taxable services have been subject to VAT at the standard rate of 16%, except for the business process outsourcing services, which have been zero rated. So this has made Kenya very uncompetitive for business. However, even with the exemption, we do not see a relief, since the exporters of these services will not get a chance to deduct the input tax, which they incur in the provision of these services, which will mean that the cost of exported taxable services will continue to be high in Kenya. The other proposal is to exempt transfer of business as a going concern. So with effect from 25th April 2020, transfer of business as a going concern has been subject to VAT at the standard rate of 16%. But this proposal there's a proposal to exempt this from VAT, which means that upon transfer of a business, there will be no VAT payable. So this comes as a relief for companies planning to restructure their operations in Kenya. The next one is an introduction of VAT on compensation for the loss of taxable supplies. So anytime when you receive compensation for loss of an asset, then you'll be expected to account for VAT. The rationale behind this change is not clear, since compensation is not a consideration for taxable supplies in Kenya. The next change is on change of VAT status of certain products and services from exempt to taxable. And this includes capital goods meant to promote investment in the manufacturing sector, affecting goods or investments that are worth 2 billion shillings and above. So this means that anyone importing goods and will have to account for VAT on these goods at a standard rate of 16%. There's a similar proposal to tax plant machinery and equipment used in the construction of a plastics recycling plant in Kenya. So this is not a good proposal from an investment perspective, since anyone planning to put up these investments in Kenya will have to pay VAT on the goods imported for construction of Then the next one is a change of VAT status from zero rate to exempt. So a couple of products and services have had their VAT status changed from zero rate to exempt. And this includes agricultural pest control products, fertilizers, and transportation of sugarcane from the farms to the factories. So the effect of this is that VAT on provision of these services is not deductible if the bill passes into law, and this will make the cost of these goods and services more expensive. The final proposal there on VAT is that the bill has proposed to add additional VAT exemptions, especially on medicaments, with a view of making the medicaments and vaccines affordable to its citizens. There is also a proposal to exempt tea as applied in Kenya for value addition before it's offloaded to the export markets. I'll stop there on VAT and move on to excise duty proposals. The first proposal there is a proposal to remove the provision or the adjustment of specific excise duty rates on an annual basis. You recall that currently in Kenya, the excise duty rates are adjusted on an annual basis by the Commissioner General. And this is to ensure that these specific duty rates are in line with the current rate of inflation within the country. So if the bill passes into law, this provision will be repealed, and which means that excise duty rates will now only be amended through the Finance Act. The next proposal is on remission of excise duty to the Revenue Authority. So the companies or people in the betting and gaming industry will be required to remit excise duty payable to the Revenue Authority within 24 hours. And there is also a provision allowing the commissioner to extend this requirement to remit excise duty within 24 hours to other accessible services. The other one provision or proposal is to remove certain products from the habit of excise duty. And this one affects mainly the petroleum products with the removal of condensates. Condensate is one of the ingredients used in the manufacture of petroleum products. And the aim here is to try and make the petroleum products high in light of the current high prices of petroleum products. We've also seen the government introduce excise duty on new products, and this includes excise duty on imported fish, which shall attract excise duty at the rate of 20% or 100,000 shillings per metric ton. Then there is sugar, which will attract excise duty at 5 shillings per kg, and human hair, among others, that will attract excise duty at the rate of 5%. We've also seen the government attempt to harmonize excise duty payable on certain services. For example, money transfer services by cellular phone providers, and also the financial and the banking institutions. So there is an attempt to harmonize this and subject the money transfer services at the rate of 15%. So currently, cellular phone providers charge excise duty at 12%. So there is a proposal to increase this from 12% to 15%, and also reduce money transfer services by financial institutions from 20% to 15%. And that will make sure that the money transfer services in Kenya, or rather the excise duty payable on this service, is aligned at 15%. We've also seen an attempt by the government to increase excise duty on certain services. For example, like I've explained, the money transfer services by cellular phone providers. Also, the betting and gaming industry has been affected because the excise duty rates on this industry moves up from 7.5% to 20% of the amount at stake. So this is an attempt by the government to collect more revenue from this industry. So I will stop there and invite Juliet from Uganda to take us through the next session.
Good afternoon, everyone. Good morning, good evening, wherever you're listening from. My name is Trevor Lukanga. I'll start from an income tax perspective, then thereafter my colleague Julie will join us. I'm going to take you through the income tax side of things as well as tax administration. So from a Uganda perspective, generally the amendments that have been made this time around, the final amendments, that is, you'll notice that most of them do not increase tax per se. However, what we are seeing is, hello, can you hear me?
Yes, we can hear you, Trevor.
Okay, thanks, because I saw. Okay, so I'll just, because I lost the slide, so I'll just speak off. I don't know what happened to the slide. So anyway, so I'll just say, so from a Uganda perspective, the tax changes or enhancements that we've seen this time round are more to do with trying to make the act, better, or, make some of these provisions clearer, and not really increase in tax per se. So what we had at the beginning was, there was a raft of changes that was made. However, because of, there was a lot of public outcry as well as lack of clarity in some of the provisions that were being suggested. So what we saw was the Minister of Finance withdrawing some of the proposals that had initially made it to the bills. So our discussion today is really a summary of what we expect to come through as the final draft for the bills, as opposed to, what came out initially, because a couple of changes happened between about beginning of April when the bills were out and about mid-May when, the final draft bills were released. So we expect, if all goes as planned, whatever we are saying, most of the bills are going to take effect from 1st of July 2023. So when the various acts are sent to by the president. So quickly going to the tax administration. So generally from a tax administrative perspective, one of the changes that we are seeing, similar to what we are seeing elsewhere in the region, is the need to collect tax. And for this particular amendment, going forward, government will require that all persons registering documents with or lodging instruments with any government entity would be required to provide their TINs. And if this is one of the things that we are seeing government change in terms of trying to increase on the collection of stamp duty, because some of the audits that have been ongoing have yielded good tax when it comes to stamp duty. So one of the things you're seeing is that they also then now trying to use government institutions to ensure that they collect stamp duty, because once you have a TIN, then being assessed for stamp duty will be easier. Then the other amendment that came through, which is really a welcome one, is to do with the clarification on the order of payment. So the amendment is to the effect that once tax is paid, so tax paid will have to offset principal tax. So this is quite helpful, because what we've been seeing is that it's not been very clear in terms of how taxes are offset once a payment is made. So we've been seeing the URA make payments against ledgers, and the order of payment has not been strictly followed. So this amendment helps in a sense that whenever a payment is made, then it will only first be utilized for offset of principal tax. Then whatever is left of the interest you could pay off whichever interest is left. So that's a welcome one. The other one is just, limiting the powers. Currently in the Tax Administration Act, the powers to waive any tax is given to the Minister of Finance on recommendation of the Commissioner General from the URA. However, government is now saying there will be an additional layer, in which case then Parliament needs to give approval for such waiver. Then the other one is around the waiver of interest. So this is some sort of, voluntary disclosure program, which we have seen in Kenya and some of these other East African countries, whereby now government is suggesting that if a payment is made before 31st of December 2023 in respect to outstanding tax, then interest and penalties would be waived. So what we had in the beginning, for the first set of the bills, there was some form of requirement for voluntary disclosure. However, what we see in the final bills, we are unable to, the waiver is not going to be based on, voluntary disclosure, but more of payment, and similar to what, Nicholas has been saying from a Kenyan perspective, government needs taxes to be paid. And as a result, even the deadline for payment is being shortened, because that's on the 6 months window. So that would, well, much as it's short, but I think it's a welcome decision in terms of trying to waive whichever interest and penalties outstanding, then also that will help in terms of the ledger reconciliation for the various taxpayers. Then the other amendment is to do with the providing of information. So URA has been of the view that, there are a couple of frustrations when it comes to audit. Either taxpayers are not responding on time, or the information that is submitted is not adequate. So what this bill is suggesting is that once the URA requests that you provide information, and that information request relates to a period of 3 years, that information ought to be submitted as and how requested by the URA. If it's not submitted, then that information would not be considered for purposes of any objection or alternative dispute proceedings. So that may be quite challenging, especially if that some of the information being requested is not readily available, but we wait to see how this will pan out. Then the other two are really, same message that we're hearing across the region in terms of digital stamps. So penalties are being introduced for unauthorized appearance, or fixing tax stamps on wrong goods. And the penalties can be very punitive, although they are upon conviction and they can go as high as 100 million, which roughly say about $27,000. So the penalties will be quite punitive. And what we understand from the various players in the industries who are producing excisable goods is that this may be very difficult because, one, in terms of implementation, most of these, for example, if it comes to the goods, you'll find players who have so many volumes. The volumes are different, the types of the goods are different. So there is no intention to fix a wrong now, at least because it's upon conviction, then probably that will help. But there's a lot of outcry in terms of how this is going to be implemented because of the volume of goods that is produced. Then from an income tax perspective, one of the amendments in the bills that is coming up is the definition of a company. So what the current definition of a company includes a unit trust, and that is being deleted from a definition of a company. So there's been a lot of outcry in terms of how unit trusts are being taxed, and in particular income of the unit holders. So what we've seen in the recent past, the URA was of the view that a unit trust would be a company based on the definition in the Income Tax Act, and on that basis, then the argument that the URA was making is that then the distributions that would be made from the collective investment schemes are akin to dividends, and therefore tax is being levied on the dividend. So what we've seen is that this amendment if this amendment makes it, well, I think that sort of clarifies the issue on a unit trust not being a company. However, unfortunately, it still remains, there's some ambiguity in terms of how the unit holders will be subjected to tax, and we understand discussions are still being had at a policy level to see how this clarification is going to be made, especially for income receipts of the unit holders, because there is some ambiguity in the industry which really needs to be clarified, and a unified position should be given. Then the other one is just around the amendment being made in respect to withholding tax on gaming. So currently we have a withholding tax of 15% on gaming. So that has been deleted. However, on the other side, the gaming tax has been increased from 20 to 30%. And we understand that the removal or repeal of the withholding tax is really due to the fact that it's been difficult in practice to collect that. People go and gamble, then, place stakes, you win, then re-gamble again. So it's very difficult to determine the withholding tax. So as a result of that, the 15% was repealed. However, the gaming tax was increased from 20 to 30. Then the other one, in terms of the financial services, so what we currently have is that interest deductibility is limited to 30% of tax earnings before interest, tax depreciation, and amortization. So that cuts across all industries other than financial institutions. So the definition that we currently have of financial institutions is limited. So it was limited really to the commercial bankers, and this exemption was also being given to the insurers. So the microfinance institutions and deposit-taking institutions were not, interest incurred by them was being limited because they did not fit within the definition of a financial institution. So this amendment now clarifies the fact that the interest incurred by either microfinance deposit-taking institution will not be limited to the 30% tax EBITDA for all entities that are within a group. Then the other one, which is really based on reducing the allowances given under the Act, we have initial allowance of 50% or 20% for eligible property located within a radius of 50 kilometers outside Kampala. So investments that have been made in the past or currently with respect to property that is eligible for initial allowance, they have been enjoying this, and the 20% rate would apply to industrial buildings, whereas the 50% really applies to plant and machinery. So the argument that is being made at a tax policy level is that the deductions, the allowable deductions, are too favorable for taxpayers. So as a result of that, the initial allowance is being repealed. Then lastly is the implementation bill with regards to the multilateral competent authority agreement on automatic exchange of financial account information, which also relates to the mutual agreement on assistance in tax matters. So what we have had in the past is that the Act was amended and provisions were included to allow for those two agreements, which is the Multilateral Competent Authority Agreement on automatic exchange of national account information, and then the other one with a mutual agreement on assistance in tax matters. So there was no implementation bill or regulations. So the minister was tasked to come up with regulations. So those regulations have come. So, however, the big takeaway here is that for the financial institutions, what we expect to see is that if this bill is assented to, so come with effect from 1st of January 2024, so there would be a requirement for financial institutions to start submitting returns to the URA in respect of reportable accounts held by non-tax residents. So this really is similar to the FATCA that we see from the US, and the definition of financial institutions is quite wide. So it handles asset managers, you're looking at banks, you're looking at financial institutions. So it's quite broad. So we expect this to start effective 1st of January 2024. So if it's passed into law, then for accounts that are being held for for the period from 1st of July 2024, especially non-resident accounts and all. So we expect URA to then also provide guidelines on what a return would look like so that the financial institutions are able to disclose this information. So that's it from a direct tax perspective. Allow me to hand over to my colleague Julie, who will take us through indirect taxes.
Thank you, Trevor. My name is Juliet Najinda. I'm a senior manager in the Uganda office, PwC. I'll take us through the indirect tax changes that is covering VAT and excise duty. So from a VAT perspective, what we are seeing in the bills now is that government is trying to widen the scope for taxation of digital services. And here what they've done is to widen the definition of what it is that qualifies as digital services. So they've introduced new items that were previously not in the Act, items like the streaming platform, subscription-based services, and cab hailing services. So this will capture companies like Uber, that's one of the popular cab hailing services, and all other companies that provide, non-resident companies that provide such services to non-VAT registered persons in Uganda. So the other thing that we are seeing in the VAT Act is that there are some additional restrictions that are being proposed in the bill around claiming of input VAT. And the first one relates to the VAT that would have been claimable by the non-residents who provide digital services in Uganda. So here, such non-residents, you'd expect that if they say hire maybe lawyers or tax consultants, and the tax consultants invoice them, then we'd expect that the non-residents are charged VAT because they are using those tax services in Uganda. But then the law is coming out to provide clarity that the non-residents would not be entitled to claim that VAT, so it will be an absolute cost to them. The other amendment is around expansion of the definition of entertainment. And here the government is now proposing to restrict input VAT claims on things like gyms and sporting associations and other recreation activities. So here, what has been happening is that you'd find that people who engage gyms and have to get charged VAT, they would front the argument that if you're paying for your employees for a gym or a recreational activity, it's equivalent to providing a health benefit, because we are in an era where people sit a lot and going to the gym is no longer a recreational activity. And so they would claim VAT on the basis that this did not qualify as entertainment. But now the Act is coming out to clarify that going forward, VAT that is incurred on such activities would not be claimable. Then the other restriction is around input VAT that you would have incurred if you have a business that is diverse. Say, for example, we've seen cases where someone is constructing a mall and they decide to register for VAT because as they construct the mall, there's a lot of input VAT that they can claim as they provide maybe advertising services. They provide the fence of the mall to the public for advertising services. And so you'd find that by the time the mall is completed and the person is able to get rental income, then they have a lot of input VAT to offset it against. So now this restriction is coming in to require you to only be able to claim VAT that you have incurred against a related business. Then the other amendment that we have seen in the Act is around the VAT, the people who auction items. The VAT bill is now coming out to require auctioneers of goods to be the ones to account for VAT. So this provision is still ambiguous because typically the companies that undertake the auctioning services would not own the goods, and what they would be required to account for VAT on before this bill came into place would be just the auctioneer services that they provide. But now the law is being amended to require them to also account for VAT on the goods that they provide. So meaning if an auctioneer, say for example, is supporting a bank to auction a house or any other thing that they are seeking to auction, then it's the auctioneer that is supposed to account for VAT in that case. Then the other one is just an expansion of the, is just a restriction of the exemption regime. And here we are seeing that government is repealing the exemption that was existing on diapers, the baby diapers and the adult diapers will now be subject to VAT with effect from 1st July. And then there's an expansion for the exemption regime to include concentrates that form part of animal feeds. In Uganda recently, we had a debate where people who are farmers who are bringing in concentrates were being tasked to account for VAT on those concentrates on the basis that the concentrates did not form part of the exempted animal feeds. So the bill is now coming out to clarify that the VAT exempted animal feeds include concentrates. So then moving on to the excise duty section. So from an excise duty perspective, we had an interesting scenario in Uganda last year where the excise duty bill did not get assented to by the president. And so we found that the bill that has come through this year for excise duty is pretty much similar to the bill that did not get assented to last year. So hopefully this time around we'll have the president assent to it so that we have the proposals passed into law. So the first proposal that we are seeing in the excise duty amendment bill is around the exemption of excise duty to incoming calls from Tanzania. So currently, if you're making a call, if you have someone in Tanzania making a call to Uganda, there will be excise duty applicable at a rate of 9 cents per minute. Yet if the call is coming from another East African country, say for example, Kenya or Rwanda, this 9 cents would not apply. So this proposal seeks to harmonize the law so that all calls coming from within the region do not attract excise duty, are not charged excise duty. The other proposal is around reduction of excise duty on opaque beer. This one, we have seen it coming through over the last 4 years because government is trying to promote local industries that produce this kind of beer. So there's been a proposal to reduce both the ad valorem rate and the fixed rates of excise duty that apply to the opaque beer. Then there's also a proposal to exempt the undenatured spirits that are used in manufacturing sanitizers. This also came through last year because government was trying to promote that industry, especially when we're still at the peak of COVID and sanitizers had become a basic need. So the exemption is still being upheld in the current bill of 2023 to exempt such undenatured spirits. Then the final exemption that we are seeing, the final amendment in the excise duty amendment bill is around just lowering the threshold for investment, for the large investment projects. And right now, such that the investors who invest about $50 million are the ones who would be exempted from excise duty, but the bill is now proposing to lower that threshold from $50 million to $35 million for non-residents. The citizens here include both Uganda citizens and East African citizens from within the East African partner states. So those are the changes, the proposals from an excise duty perspective. I'll now invite my colleague Rwanda to take us through the changes, the proposals from Rwanda.
Thank you, Juliet. So I'll take us through some of the changes that are being recommended in Rwanda. And as mentioned by Johnson earlier, Rwanda doesn't really have a finance bill. What we do have is the medium-term revenue strategy, which is a sort of a package of reforms that will allow Rwanda to improve its revenue resources and meet its social and economic objectives. The reforms are, at the moment, they're kind of being approved in tranches. So there are some reforms that have already been assented by the cabinet, and we're expecting to see them in the coming year. And then there's some reforms that are probably going to come in the medium term. So to start off with income tax, the change that has been approved by the cabinet is a reduction of CIT, corporate income tax, from 30% to 28%. And the target is to get this to 20% in the medium term. The idea is to improve Rwanda's competitiveness in the region and to attract more investment. But at the same time, this reduction in CIT rates is expected to go hand in hand with phasing out of tax incentives that are currently being offered to players in different economic sectors. So once the CIT rate is harmonized, I think most of the tax incentives will be phased out as well. Some of the other changes that are still in the process of being discussed but haven't been assented to yet is the introduction of minimum alternative tax, which we understand in some other countries in the region has already been put in place. The intention is for this to be applied on entities that are loss-making, so tax them on turnover instead of the taxable profit. In addition to this, other changes that are being considered for corporate tax is the immediate expensing of capital expenditures instead of letting taxpayers work out the tax depreciation versus the accounting depreciation. As a simple way to move forward, one of the proposals is to just allow immediate expensing and also include an indefinite carry forward of losses, as currently Rwanda has a limit of 5 years for carrying forward of losses. And then when we go to VAT, next slide. Okay. So some of the changes that have been assented to by the cabinet include the introduction of an exemption from VAT on rice and maize flour for both domestic trade and imports. And the intention of this amendment is sort of to improve the food security for the country. The other change is the exemption from VAT on transfers of assets between related parties in the context of a group reorganization. As mentioned by my colleague from Kenya earlier, Kenya also considered a similar change in terms of exempting transfers of going concerns, and this is sort of a similar provision. However, it's limited to transfers between related parties. Yeah, so that's sort of a limitation when compared to the way this rule is applied in other countries in the region. And the other change that's coming in the law is the zero rating of VAT on electric vehicles. The idea is to promote the transition to a clean powered vehicles. So yeah, so that's on the incoming changes. And then when we come to some of the changes that are being proposed but are yet to be implemented, there's the introduction of VAT on digital supplies, and we understand this will be in line with what other countries in the region have done so far. And in addition to tax on digital supplies, you have zero rating of VAT on construction of residential houses. And the main intention of this is to just facilitate the creation of affordable housing for people of low income. And then finally, you have the introduction of 10% VAT rebate to customers when they receive an EBM receipt. This rebate basically has been introduced as a way to promote compliance and sort of incentivizing customers to seek out an EBM receipt. Yeah, so that's it from income tax and VAT. I'll let my colleague Emmanuel to take it on for excise duty.
Well, thank you, Hannah. And please confirm if I'm audible.
Yes.
Oh, perfect. Thank you. As my colleague, sure, thank you. As my colleague Johanna said, so some of these changes, they have already been approved by the cabinet, and so in terms of excise duty, the first two that you see there, they have already been approved by cabinet. The first one is the introduction of the cap on excise duty on high-end products, especially wines and liquors. So Rwanda has invested heavily on tourism sector, and so I mean we're seeing and it's working quite well, and we're seeing a lot of tourists coming in. But now the country is trying to get a lot from tourists in terms of would want them to be spending quite high while they're in country, and as we all know, those tourists are the bigger portion of those people who spend in these imported liquor and wines. But there have been some difficulties there because the reason being these imported wines and liquors tend to be quite expensive, and the reason behind that is the excise duty, which is currently 70% of the excise value. So you could imagine for those high-end products, that excise duty will be quite material, and the products will end up to be very expensive, and we won't get a lot of consumption on those. So now the cabinet has approved a cap of 50,000 Rwandan francs, which is approximately 50 USD. So now the excise duty will go all around, but won't go above that 50 USD. And the idea there is to boost the consumption of those tourists that we're seeing coming in quite a high number in the country. And apart from that, we are also seeing the exemption from excise duty on electric vehicles. So this is one of those changes that they have already been approved by the cabinet, and they are actually being implemented right now. So right now, if you are importing electric vehicle, it will be exempted from excise duty. However, it's yet to be legislated. It's yet to be captured in the law, but we're expecting this one to be captured in the updated legislation that's coming. But the idea behind here is, as my colleague said, the increase in environmental concerns all around the world, which is a hot cake actually. So Rwanda, has taken a step forward to push the use of electric vehicles. So that's why you can actually see we're exempting it here in excise duty, and as well as my colleague said, in VAT is going to be zero rated. But more than that, it's also going to the second one there, which is the increasing of excise duty on older vehicles. So all of that, the essence of all of those three is actually to push the citizens to move all the way to electric vehicles and get rid of these older vehicles. So we're also expecting in the medium term the increase in excise duties on older vehicles. Apart from that, we have another change that has been passed by the cabinet, and we're expecting it to be to come into implementation anytime soon, which is the introduction of stamp duty, or rather a tax on a sale of immovable property. So currently Rwanda does not have a stamp duty. Like, you're not having any tax when you're selling your immovable property, but the cabinet has passed a 2% tax on the property value that will be charged whenever a property holder is disposing his property. it's a new introduction, so we do not have much of information how it's going to be implemented, but we're expecting it to be documented very well in the updated legislations. So that's it from Rwanda perspective. I'll hand over the mic to Johnson for the closing remark, I believe. Over to you, Johnson. Thank you.
Thanks, Emmanuel, and thanks all the presenters from the PwC side. I think in interest of time, I'll just hand over the mic to Adrian to take us through the next step, or probably provide the closing remarks. Thanks everyone for the participation, and maybe Adrian will guide us on the next steps if we're taking questions.
Okay. Okay. Thank you all the presenters from the PwC across the EAC partner state. Actually, we have actually eaten our time, 13 minutes. But actually, it is very important if I invite some burning questions. If you have any burning question, but also actually before asking any question, you can drop your email in our chat so that we can share the presentation from the expert. But also we have some few remarks from the chat. And here we have one from John, who actually is saying that the beverage industry in Tanzania are also actually asking for the stability of excise duty, where actually their proposal is for no changes of the excise duty in Tanzania for the beverage, and also the reduced rates cost on the digital tax stamp. As my chair said, I think we have a challenge with the digital tax across the region, and the appeal is for the partner state actually to make sure that they reduce the cost of the digital tax stamp. So if you have any burning question, please raise your hand, then we'll give you a chance to ask question. Be very brief and direct your question to the presenter, either Tanzania, Kenya, Uganda, or Rwanda. Any query, any questions? Okay, I can't see any hand. So I will request our CEO to make a closing remarks.
Thank you very much, Adrian. Again, I want to start my closing statement by appreciating the chair of the subcommittee, Simon Kahel, who has been really providing leadership in this exercise, and I want to appreciate and applaud the PwC for that excellent comparative analysis in terms of various tax regimes and measures being introduced in our budget. And I think this gives us the feeling where we are going, and I'm happy some countries, again, I was listening attentively when you look at like Uganda. I think they have listened to the business community. Some of the measures they were planning to introduce have not been introduced. And I see also Kenya, and I think Tanzania, some positive strides are being made in terms of aligning their tax regime, and again to thank PwC in terms of the improvement, the comments they are making to the government, and looking at those measures that will have a detrimental impact on business. So I think this is a very good insight, and I really want to appreciate everyone. Thank all our stakeholders, our members, EABC members, and we will continue to dialogue around the tax. And again, reflect on what Adrian is saying, the distortionary effect of taxes on business, on the growth of business. We need to reflect on that so that we ensure that as a region, we need to harmonize our tax regime. We need to harmonize our tax rates so that we provide a kind of a fair system in terms of our taxation regime. It is also important that the issue of predictability of the taxes, the issue of certainty and efficiency in terms of administration is taken into consideration. So we look forward again to ensure that those proposed measures integrated in our budget proposal come June. And our government listen, and usually they are listening to the views from the private sector in terms of those measures that will be detrimental. So again, the insight has been very instrumental, and as the EABC, we are committed and determined to ensure that we continue engage effectively in matters that relates to doing business in East Africa. We want to assure you that we want to position EAC as the best, the most preferred region in terms of investment, in terms of doing business. We can only do that once we highlight those challenges, those hurdles related to taxation, as well as other issues that impede doing business in South Africa. So with that, again, I want to thank all the excellent presenters from PwC across the region, and assure you our partnership, our continuous engagement, our cross collaboration, and take this opportunity again to invite you for those who have not registered for upcoming Trade and Investment Forum in Uganda, come 30th August this year. Asanteni sana, and I wish you a very great afternoon. Over to you, Adrian. Thank you.
Okay. Okay, thank you very much, Edie, for the closing remarks. We thank all the participants. And as I said, please drop your email in our chat room. And then I think we will see each other next year, because as you agreed, actually this event is supposed to be the annual. So until June or May next year, please be tentative to the budget reading on 15 June this year. Thank you very much.